The ledger arrived on a Tuesday morning in March, delivered by a man nobody remembered seeing before. He wore a gray overcoat despite the unseasonable warmth, carried the leather-bound book under his arm like a Bible, and asked for the floor manager by a name that hadn't been used in 5 years. When the receptionist corrected him, the man smiled with the practiced patience of someone accustomed to such mistakes, set the ledger on the counter, and walked back into the street. By the time anyone thought to check the parking lot, he had vanished into the ordinary flow of midday traffic. The ledger sat unopened for 3 hours before curiosity overcame protocol. Inside, written in meticulous columns, were numbers that matched no invoice, shipment, or transaction the warehouse had processed in the previous 18 months. Beneath those numbers, in handwriting so precise it seemed mechanical, was a single annotation: settlement for services rendered, accounts balanced, parties notified. No signature, no date, no explanation of what services, which accounts, or whom among the various parties had been notified of anything at all. The warehouse itself occupied 4 acres on the industrial margin of a city that had grown too quickly around it, leaving this particular structure stranded between abandoned rail yards and the expanding suburbs of young families who never wondered what happened behind its windowless walls. Built in the aftermath of a war that had reshaped commerce and created sudden fortunes for those positioned to exploit the chaos of Reconstruction, the building had changed hands 7 times in 23 years. Each transfer occurred quietly, documented in paperwork filed at odd hours in county offices where clerks processed forms without reading them. The architectural plans showed a standard distribution facility, loading docks on the north face, office space converted from the original foreman's quarters, storage organized in a grid pattern that maximized efficiency. Nothing about the structure suggested it would become anything other than what it appeared to be. But buildings, like people, have the capacity for double lives. And this particular structure had been selected precisely because it aroused no suspicion, attracted no attention, and existed in that useful category of infrastructure people glance at without truly seeing. The operation began not with a dramatic decision, but with a conversation over dinner in a restaurant where the tables were spaced far enough apart that neighboring diners heard only the pleasant murmur of voices without distinguishing words. 3 men met that evening, each arriving separately, each having taken precautions that would have seemed paranoid to ordinary businessmen, but were merely prudent given their actual occupations. The first man owned, through a series of intermediary corporations, 17 legitimate businesses scattered across 3 states. The second man specialized in what might politely be called financial architecture, the construction of corporate structures that existed primarily on paper but possessed the legal substance necessary to move money across jurisdictions and through banking systems designed to track such movements. The third man said very little during the meal, but listened with an intensity that made even mundane observations seem weighted with significance. He represented interests that preferred to remain unnamed, entities whose influence operated through layers of insulation so complex that tracing authority back to its source required either extraordinary resources or extraordinary recklessness. What they discussed that evening would later become the subject of considerable speculation, though no recording existed and none of the participants would ever provide a complete account. The essential problem they addressed was one that had confronted their predecessors for generations: how to transform money acquired through activities that law enforcement agencies found objectionable into assets that could be deployed openly, invested legitimately, and passed to heirs without triggering investigations. The traditional methods had grown increasingly precarious. Banks had begun employing specialists trained to identify suspicious patterns. Real estate transactions attracted scrutiny. Casinos, once reliable instruments for such transformations, now operated under regulations that required uncomfortable documentation. What these men needed was something both mundane enough to escape attention and flexible enough to accommodate the irregular flows of capital that characterized their operations. The warehouse emerged as the solution during the third round of drinks, proposed almost casually by the financial architect, who had spent the previous 6 months studying distribution networks and their relationship to legitimate commerce. The beauty of the concept lay in its simplicity. Warehouses moved goods constantly. Inventory flowed in and out with sufficient volume that minor discrepancies vanished into the normal variance of business operations. More importantly, warehouses dealt extensively in cash transactions with small suppliers, subcontractors, and independent truckers, exactly the kind of nebulous commercial interactions that created opportunities for creative accounting. A warehouse could show revenue from services that were only partially rendered, charge fees for storage that never quite occurred, and process invoices for shipments that traveled routes impossible to verify weeks after the fact. Unlike a casino or a nightclub, which existed to entertain and therefore attracted public attention, a warehouse functioned as infrastructure. It was boring. It was forgettable. It was perfect. The acquisition happened through channels so deliberately complex that reconstructing the ownership chain would later require forensic accountants and subpoenaed records from banks in 3 countries. A shell corporation registered in a jurisdiction known for its discretion purchased the property from its previous owners, who were quietly encouraged to accept an offer slightly above market value and strongly advised not to ask questions about the buyer's long-term intentions. The transaction closed on a Friday afternoon. By Monday morning, a new management company had assumed operational control, bringing with it a team of employees whose resumes showed impeccable credentials and whose backgrounds, had anyone investigated thoroughly, would have revealed concerning gaps and suspicious patterns. The warehouse continued operating exactly as it had before. Shipments arrived and departed on schedule. Clients received their goods without delay or complaint. Nothing visible changed, which was precisely the point. The actual mechanism of the operation revealed itself gradually to those who worked there, though most employees never understood the complete picture. Legitimate businesses used the warehouse for exactly the services it advertised: storage, distribution, light assembly work. These activities generated real revenue and created the foundation of plausible commerce upon which everything else would be built. But interwoven with these legitimate transactions were others that existed primarily on paper. Invoices would arrive from companies that maintained corporate registrations and tax identification numbers, but possessed no actual employees or physical locations. These phantom entities would bill the warehouse for consulting services, specialized transportation, or equipment rental. The warehouse would process payments to these companies, which would then transfer the funds through additional layers of corporate structure until the money emerged, sanitized by its journey through seemingly legitimate business channels, ready for deployment in investments that attracted no attention from authorities who might otherwise wonder about the source of such capital. The people who executed this system operated with the precision of surgeons and the discretion of priests. The floor manager, a man in his middle 40s, who had spent 2 decades in legitimate logistics before being recruited for this particular position, understood that his primary responsibility was maintaining the appearance of normalcy. He hired competent employees who performed their duties efficiently. He negotiated fair contracts with trucking companies and suppliers. He addressed maintenance issues promptly and kept the facility in compliance with all relevant safety regulations. His behavior aroused no suspicion because there was, in fact, nothing suspicious about most of what occurred under his supervision. The illegal aspects of the operation touched his work only tangentially, appearing as occasional instructions to process invoices through particular accounts or to ensure that specific shipments received special handling. He learned not to ask why certain transactions required such attention. He learned that curiosity in his position was a liability rather than a virtue. The financial controller, a woman whose accounting credentials were genuine, even if her current employment served purposes beyond conventional bookkeeping, maintained dual sets of records with a meticulousness that would have impressed legitimate auditors had they ever been permitted to examine her work. One set documented the actual operations of the warehouse in scrupulous detail, tracking every shipment, every expense, every routine aspect of the business. The other set, stored in encrypted files accessible only through passwords changed weekly, recorded the parallel transactions that justified the operation's existence. She understood the mathematics of money laundering with the same fluency a composer understands harmony. Money moved through her carefully constructed accounts in rhythms designed to avoid triggering the automated systems banks employed to identify suspicious activity. Large sums were broken into smaller amounts. Transfers were timed to occur when human oversight was minimal. The digital signatures of legitimate transactions were replicated with sufficient accuracy that distinguishing real business from manufactured activity required either insider knowledge or the kind of forensic investigation that could only occur after suspicion had already been aroused. The psychology of those involved revealed patterns that students of organized crime would have recognized immediately. None of these individuals thought of themselves as criminals in any conventional sense. They rationalized their participation through a variety of cognitive mechanisms that permitted them to maintain self-respect while facilitating activities they would have condemned in others. The floor manager convinced himself that he was simply managing a warehouse. What happened in accounting was not his concern, and he was not responsible for decisions made by executives whose names he barely knew. The financial controller viewed herself as a technician, someone who applied her skills to solve complex problems without moral judgment about the ultimate purpose of such solutions. She processed transactions the way a translator renders text from one language to another, faithful to the technical requirements of her craft while remaining deliberately incurious about content. This compartmentalization extended throughout the operation. The truck drivers who occasionally transported unusual shipments were paid generously not to remember details. The clerks who processed certain invoices were selected for their willingness to follow instructions without seeking explanations. The maintenance workers who installed additional security measures were given plausible reasons for such precautions and never encouraged to wonder why a warehouse storing mostly commercial goods required surveillance systems more sophisticated than those employed by facilities housing high-value merchandise. Each person involved knew only what they needed to know, creating a structure where no single individual, except perhaps the silent men who met in expensive restaurants, possessed complete knowledge of the operation's scope and purpose. The warehouse absorbed cash from enterprises that generated such currency in troubling abundance. Gambling operations that existed in neighborhoods where enforcement was sporadic and corruption endemic produced streams of small bills that needed transformation. Loan sharking networks, which operated on the eternal principle that desperation creates opportunity, cycled money through arrangements that left no conventional paper trail, but generated revenue that eventually required legitimization. Drug distribution networks, perhaps the most lucrative of all prohibited commerce, created cash flows so substantial that managing them became logistically challenging. Money had to be counted, stored, transported, and processed in ways that avoided both theft by employees and detection by authorities. The warehouse became one nexus in a larger system designed to address these challenges, accepting payments for services that were real enough to satisfy cursory examination, but inflated sufficiently to accommodate the absorption of unaccounted capital. The invoicing schemes employed a creativity that would have been admirable in legitimate contexts. A trucking company would bill for transportation services at rates that reflected not the actual cost of moving goods, but the need to justify specific payment amounts. If $30,000 required processing, the invoice would reflect a shipment of sufficient size and distance to make such expense plausible, even if the actual truck was half empty and traveled a shorter route. Storage fees were similarly flexible, calculated not by square footage and duration, but by the requirements of the financial architecture. Equipment rental charges bore little relationship to market rates, instead serving as vehicles for transferring predetermined sums from one corporate entity to another. The entire structure operated on the principle that most auditors, even suspicious ones, would accept documentation that appeared superficially legitimate unless they possessed specific reasons to investigate deeper. The psychological tension of maintaining such an operation manifested in subtle ways. Employees developed habits designed to manage the ambient anxiety of knowing without acknowledging that something about their workplace wasn't quite right. They avoided certain topics in casual conversation. They learned not to notice when executives visited the facility at unusual hours or when shipments arrived without proper advance documentation. The floor manager began drinking more heavily than he had in previous years, though he insisted to his wife that the stress came from ordinary workplace challenges. The financial controller developed insomnia, lying awake at night not quite admitting to herself that she was calculating exit strategies and wondering whether her involvement, should the operation ever be exposed, would be considered peripheral enough to escape serious legal consequences. The warehouse existed in a state of productive paranoia, alert to threats without being paralyzed by them. New employees were vetted through processes more thorough than those employed by legitimate businesses, though such scrutiny was explained as necessary diligence for a company handling valuable inventory. Visitors were discouraged. Tours were never permitted. Deliveries were scheduled to avoid having too many external people present simultaneously. The security system recorded everything, ostensibly to prevent theft, but actually to ensure that no unauthorized activities or conversations could occur without detection. Trust was never assumed. It was continually tested through methods subtle enough that most employees never realized they were being evaluated. The operation succeeded for years precisely because it was designed to be boring. Authorities investigating organized crime focused their limited resources on obvious targets, nightclubs that stayed open too late, and restaurants where known criminals congregated, legitimate businesses that showed suspicious cash flows. A warehouse in an industrial district, processing legitimate shipments alongside fabricated ones, never rose to the level of investigative priority. Even when informants provided information about money laundering operations, they described what they knew: nightclubs, real estate deals, corrupt officials, but rarely mentioned distribution facilities because few people outside the highest levels of criminal organizations understood the role such infrastructure played in the larger system. The tension in such operations comes not from dramatic confrontations, but from the gradual accumulation of small anxieties. A new banking regulation that requires additional documentation, a change in auditing procedures at a client company, an employee who asks too many questions or pays too much attention to transactions that should have remained invisible, a newspaper article about money laundering prosecutions in another city that employs methods uncomfortably similar to those being used. Each of these minor developments creates ripples of concern that propagate through the organization, requiring reassurance, adjustment, or in some cases, the quiet elimination of personnel who have become liabilities. The warehouse's position within the larger criminal ecosystem meant that it was simultaneously valuable and expendable. The organizations that benefited from its services understood that any single operation could be compromised and that preparation for such eventualities was essential. Backup systems existed, other warehouses in other cities, different methods of processing cash, alternative corporate structures that could be activated if this particular node in the network became untenable. The people running the warehouse probably understood this calculus, though they preferred not to articulate it even to themselves. They were useful as long as the operation remained secure. Should that security be compromised, they would be abandoned with the same cold efficiency that characterized every other aspect of the enterprise. The mundane details of criminal infrastructure reveal more about the nature of organized crime than dramatic violence or spectacular heists. The warehouse represented not the glamorous aspect of criminal enterprise, but its necessary foundation. Money must be laundered, records must be created, assets must be protected, infrastructure must be maintained. These requirements persist regardless of the specific illegal activities generating revenue, and satisfying them requires people willing to work within the tedious gray areas between obvious criminality and complete legitimacy. The floor manager filing tax returns for the warehouse was engaged in the same fundamental activity as the street dealer selling prohibited substances. But the differences in how these activities were perceived and prosecuted revealed the sophistication with which modern criminal organizations had learned to exploit the complexity of legitimate commerce. The unraveling of such operations, when it occurred, rarely happened through dramatic raids or the sudden appearance of authorities with warrants. Instead, erosion occurred slowly, through the accumulation of small mistakes and unavoidable coincidences. An employee who left the organization under unfavorable circumstances might retain sufficient knowledge and sufficient grievance to become a source of information. A routine audit at a client company might reveal invoices that, examined in detail, raised questions about the services supposedly provided. A bank compliance officer reviewing transaction patterns for entirely unrelated reasons might notice transfers that fit profiles associated with money laundering and file the required suspicious activity reports. None of these developments alone would necessarily compromise the operation, but together they could create a constellation of evidence sufficient to justify investigation. The psychological experience of those involved as such pressure increased would have been almost unbearable. Maintaining the appearance of normalcy while aware that scrutiny was intensifying required constant vigilance. Casual questions from employees who had previously accepted explanations without concern now seemed potentially threatening. Routine meetings with clients became exercises in performance, smiling, and discussing business while wondering whether this person was cooperating with investigators. Sleep became difficult. The floor manager might lie awake replaying conversations, analyzing whether he had said anything that could be used against him. The financial controller might spend hours reviewing her records, looking for inconsistencies that could provide evidence of criminal activity while simultaneously trying to maintain the documentation necessary for legitimate operations. The warehouse continued functioning even as pressure mounted because stopping would itself be suspicious. Operations that had been established over years could not simply cease without arousing the exact attention they had been designed to avoid. Shipments still needed to arrive and depart. Employees still reported for work. Invoices still required processing. The machinery of the operation ground forward, even as those running it felt the walls closing in, trapped in a situation where every action risked exposure, but inaction might prove equally dangerous. The records that eventually surfaced, whether through investigation or the betrayal of insiders, would have told a story that was simultaneously dramatic and banal. Millions of dollars processed through accounts that existed primarily to obscure the origin of funds. Elaborate corporate structures whose complexity served no legitimate business purpose. Payments to entities that maintained the appearance of commercial enterprises while conducting no actual business. The paper trail would reveal not a single massive conspiracy, but rather a network of small deceptions, each individually defensible but collectively damning. The warehouse itself would likely survive such scrutiny, at least physically. Buildings are neutral. They serve whoever occupies them. The structure that had housed illegal financial operations could be sold repurposed, and integrated into legitimate commerce without anyone noticing. The loading docks would continue accepting trucks. The storage areas would still hold inventory. The offices would be occupied by people who knew nothing about what had occurred in those same rooms during earlier years. This capacity for institutional amnesia, the way organizations and infrastructure can be cleansed of their histories, represents one of the profound challenges in confronting organized crime. The people involved might eventually face consequences, but the systems that enable their activities often persist, waiting for the next group being clever enough and desperate enough to exploit them. The silence that eventually settled over such operations was not the silence of resolution, but of abandonment. The warehouse would be quietly sold to investors who asked no questions about its previous owners. The corporate structures would be dissolved, their records filed in archives where they would gather dust unless some future investigation required their examination. The people who had worked there would scatter, some finding legitimate employment, others migrating to similar operations in different cities, carrying with them the knowledge of how such systems functioned and the contacts necessary to establish them again. The ledger that arrived that Tuesday morning in March remained a mystery, never fully explained. The numbers it contained corresponded to nothing in the warehouse's official records, suggesting it documented transactions that occurred entirely outside conventional accounting. The annotation about settled accounts and notified parties implied a finality, as though someone was closing books on activities they no longer wished to continue. Perhaps it represented a warning, a message sent by someone who wanted those still involved to understand that the operation had been documented and that evidence existed should it ever be needed. Perhaps it was simply an error, a document delivered to the wrong address by a courier who confused similar business names. The truth was probably unknowable, lost in the deliberate opacity that characterized every aspect of such operations. Years later, someone walking past the warehouse might never suspect its history. The building looks ordinary because it is ordinary. Most structures that serve criminal purposes are not the dark, forbidding places of fiction, but rather mundane spaces indistinguishable from legitimate businesses. The real innovation of modern organized crime has been precisely this camouflage. The ability to hide in plain sight, to exploit the complexity of legal commerce for illegal ends, and to create systems so integrated with ordinary business that distinguishing criminal from legitimate activity requires expertise most people don't possess and investigations most jurisdictions cannot afford. The warehouse stands as testimony to a principle understood by criminals and law enforcement alike. Power operates most effectively when invisible. Influence is most durable when deniable. And the most successful criminal enterprises are those that don't look criminal at all. The loading docks that served both legal and illegal purposes, the offices where legitimate business occurred alongside systematic fraud, the storage areas that held both ordinary inventory and the infrastructure of money laundering. All of it existed in that uncomfortable space where reality admits multiple interpretations and truth becomes a matter of which documents you believe and which explanations you accept. The people who worked there knew something was wrong and said nothing reveal another uncomfortable truth. Complicity is often passive rather than active. Most participants in such operations are not violent criminals or sophisticated masterminds, but rather ordinary people who made incremental compromises, each decision seeming minor at the time, until they found themselves implicated in enterprises they never intended to join. The floor manager who processed unusual invoices told himself he was just following orders. The financial controller who maintained dual records convinced herself that accounting was a technical profession requiring no moral judgment. Each person constructed narratives that permitted them to function without confronting their actual role in facilitating criminal activity. The legacy of such operations extends beyond their immediate participants. Money laundered through the warehouse eventually flowed into legitimate investments, real estate developments, small businesses, stock portfolios. The profits from criminal activity became indistinguishable from any other capital, generating returns that would be taxed, invested, and passed to heirs who might never know their inheritance originated in the enterprises that operated beyond legal boundaries. This transformation of dirty money into clean assets represents the ultimate goal of such operations and their most troubling success. Criminal organizations understood that power measured in cash was vulnerable, but power transformed into legitimate wealth became durable, respectable, and nearly impossible to challenge. The warehouse eventually closed, though whether this resulted from internal decisions, external pressure, or simply the natural life cycle of such operations remained unclear. The building was purchased by a logistics company with no apparent connection to its previous owners. New employees arrived, unaware of the structure's history. Operations resumed under management that processed only legitimate shipments and maintained only honest accounts. The past was not so much confronted as buried, covered by layers of new activity until it became effectively invisible. But those who understood criminal infrastructure knew that such closures were rarely final. The techniques perfected in one location would be replicated elsewhere. The networks established through one operation would be deployed in others. The people who had learned how to exploit the complexity of modern commerce for criminal purposes would take that knowledge with them, applying it wherever opportunity arose. The warehouse was never just a building. It was a proof of concept, a demonstration that organized crime could operate within legitimate institutions if the design was careful enough and the camouflage sufficiently convincing. The investigation that may or may not have occurred would have revealed familiar patterns. Prosecutors would face the usual challenges of proving criminal intent when documentation suggested legitimate business. Defense attorneys would argue that minor irregularities in accounting were simple mistakes, not evidence of systematic fraud. Juries would struggle to understand the technical mechanisms of money laundering, finding it difficult to believe that something as mundane as a warehouse could serve as infrastructure for organized crime. Some cases might be prosecuted successfully, others would be abandoned for lack of evidence or resources. The actual truth of what occurred would remain partially obscured, filtered through legal processes designed to operate on proof rather than suspicion. The story of the warehouse ultimately represents the evolution of criminal enterprise from crude violence and obvious illegality to sophisticated systems that exploit the very complexity designed to prevent them. Modern organized crime understood that the best hiding place was often in plain sight, that the most effective operations were those that resembled legitimate business closely enough that distinguishing between them required resources and expertise most authorities couldn't deploy. The warehouse succeeded not because it was clever in any dramatic sense, but because it was boring, mundane, ordinary. Exactly the kind of place people overlook because they assume nothing interesting could possibly happen there. As night settles over the industrial district where the warehouse still stands, lights illuminate the loading docks where trucks arrive and depart on schedule. Inside, workers process shipments with efficient precision, unaware or indifferent to the building's history. The past exists here only in documents stored in archives, in memories fading with time, in the accumulated knowledge of investigators who moved on to other cases when this one grew cold. The warehouse continues its function, neutral to the purposes it serves, waiting for whoever might next see opportunity in its ordinary facade and decide to build something extraordinary beneath its unremarkable exterior.